Hello and welcome to the EnerNova Partners Energy Market Update for May. My name is Doug Schaefer. I am the Director of Client Strategy at EnerNova Partners. And over the next roughly 10 minutes, I'll take you through, maybe a dozen slides, and we'll kind of talk about what's currently going on in the market and what the outlook, or at least what we feel the current conditions, what that outlook is for energy prices for electricity and natural gas as we go forward. So just to kind of quick little recap of what's gone over in the last, or what's happened with pricing over the last month, you can kind of see it's been a mixed bag. And it's a tale kind of the temperatures that have been occurring across the US, where the East Coast has been mild, to cooler. And you can see that West Hub, ComEd pricing, some of the New York prices have been off, while ERCOT Houston with the heat wave, the hotter temperatures that they've been dealing with, prices continue to push higher. So while we're kind of talking about weather, let's jump into the fundamentals. And the first thing we always talk about is weather. You can see that heat remains in the south. We finished up April. April was the warmest since, or I'm sorry, the 8th warmest since 1950. That trend is kind of continuing, at least on the East Coast and in the South. That's definitely putting some upward pressure on the market. And you can see over the next 2 weeks, unfortunately for Texas, those above normal temperatures are going to stick around. And that increased demand, that increased power burn using natural gas, will lift prices higher. It will impact prices probably across the entire US. As we move on to a longer outlook, the forecasts that we're currently seeing for the summer are calling for a hot one. Some forecasts are indicating it's going to be one of the top 10 hottest summers since 1950. I've seen a couple forecasts that are placing this summer in the top 5. Big reason for that, warmer than normal ocean temperatures in the Atlantic, which have a high likelihood of a very active hurricane season, as well as the transition away from a La Nina or an El Nino to a La Nina are the main drivers of this forecast. You can see month over month that July, August, September outlook hasn't changed too much, but definitely it's still north of 40 to 50% likelihood that we're going to have above normal temperatures this summer. Natural gas storage, this has probably been the single biggest fundamental that is kind of keeping a lid on power and natural gas prices right now. You can see by the chart we have a large surplus of natural gas. We're currently 620 BCF above the 5-year average, which is this green line, and we're 421 BCF above this orangish line, which is last year's levels. So the market is reacting to this glut. Producers have been cutting back. You'll see in some of the upcoming slides the impact of that. But essentially what is going on is the market, the producers are trying to do everything they can to get this dark blue line to start to trend closer to that green line in below where we were last year. And you can see some of the production cuts are starting to work. The expected injections over the next 3 weeks are 50 less than the 5-year average. So we should start to see this blue line tail off more towards those average levels for the last 5 years. But that's going to be a big play. The sooner we get to that level, I think the faster prices will go up. If we can maintain that gap and stay well above, it will help keep prices in check. One other thing to add for storage is we're seeing, and it's early, end of season for injections. Usually happens around the end of October, middle of November. And we're seeing calls for anywhere from 3.9 to 4.1 TCF. And the record high is just over 4 TCF. So we'll continue to watch that, and that will have a big impact on natural gas and power prices as we move forward. Natural gas production, you can see the purple line is the current natural gas production levels, and you can see in February the producers came out, said because of the low prices, the large surplus in storage, that they were going to reduce production. And you can see they've been very successful, dropping production from an all-time high of about 106 BCF a day down to about 98 BCF per day. EQT came out, they're one of the largest Marcellus shale producers. They came out and said they're continuing their cuts at least through the end of May, and we'll see where prices are, over the next couple weeks, and we'll see if they continue those cuts into June. One thing of note, and this kind of comes into play with production, but also demand. There's a new pipeline that's going to come into service probably by the end of May. It's called the Mountain Valley Pipeline, and it's going to move about 2 BCF per day from the Marcellus region in West Virginia down to the Carolinas. So not only are we going to need to see, we're going to see that new demand come online, and so we'll have to again watch to see how production responds to that. We're already seeing slightly higher prices in the Appalachian, that Western PA, Eastern Ohio region, and we're also seeing the basis numbers adjust accordingly as well. So next slide, with production cuts come fewer rigs drilling for natural gas and oil, and you can see the steady decline since roughly November of 2022. Over the last 6 months, oil wells or oil rigs have kind of remained steady. That's primarily due, oil's been that north of 80, somewhere probably between 80 and $90 a barrel this whole time, and at those levels it's still profitable. But you can see since February the large decline in natural gas rigs that are actively searching for new supply. So natural gas demand right now is pretty much in line with last year, so nothing too concerning there. The biggest thing is we'll watch and see if this demand starts to outpace last year, if these current forecasts for summer temperatures come true. Last summer was somewhat of a mild summer overall, and we'll see with these hotter temperatures forecasted how much this demand will grow year over year, which again should cut into that storage surplus that we have right now. So natural gas demand for liquefied natural gas, you can see here represents, this is the return of the Freeport LNG facility down in Texas. Back in January, they suffered an outage due to some freezing temperatures. It's kind of taken them a while to get the plant back in operation, but we're seeing that occur, and each day they get closer and closer to full capacity, which should take the LNG total demand up to about 14 BCF per day. So again, supply and demand side, this increase in demand is going to start to push prices up a little bit, and we'll see that as we go. When we take a look at the natural gas pricing chart, we'll be able to see where that feedstock gas has been going back, and you can see how the NYMEX has responded and started to climb as well. So switching a little bit just to electricity demand, this is PJM and their forecast for load growth. They're basically saying due to the electrification of cars, expansion of data centers, implementation of AI, they expect this load growth, you can see, to go from about 147,000 for their recent peak up over 200,000 megawatts of demand. One of the interesting things I read the other day, which was surprising to me, they were doing a comparison between if you go out and do a Google search versus if you did a search or the same kind of function with ChatGTP. The ChatGTP function takes 10 times the amount of energy as what a Google search does. And there's been talk, I know Google is implementing their own AI function, Microsoft is implementing their own AI function built into their software. So you could see as that grows, as that implementation occurs, that part can grow by as much as 10 times what the normal usage is. So again, something that we're keeping our eye on. Getting into Henry Hub pricing. So you can see here that February, or the recent turn on of the Freeport facility and that impact kind of pushing gas prices higher, both in calendar 25, 26, and 27. We were kind of range bound for a while, but we kind of broke out of that as we're getting closer to the summer. And, you know, the market is starting to look at the weather, what that expected demand could be. And they do expect by at least the 26 and 27 timeframe that storage surplus will be out. The market will be back in its normal ranges. And that is putting some upward pressure on the marketplace right now. So, oh, and one thing I wanted to talk about. So one of the things is the EIA, JP Morgan, different other investment houses will come out with their estimates on where they think prices are going to trend. And I wanted to kind of show you the two extremes of those estimates. The EIA is basically forecasting right now that by the end of this year, calendar 2025 pricing will be around $2.90. JP Morgan is forecasting that price is going to be around $4.75. Both of them have very valid arguments in their case, you know, but I think one is leaning more towards that glut, that surplus and storage sticking around, where the other one is expecting for that surplus to go away due to weather and the production cuts. And what I did on this next slide was just kind of chart it out a little bit, and you can see the EIA forecast to where prices currently are versus the JP Morgan forecast. And the biggest thing is, you know, what I've highlighted here. You know, it highlights the uncertainty between market experts and the different price outcomes. So you can see even the market experts that are looking at this day in and day out are having trouble coming up with, you know, where they think the prices are going to actually fall in. So we understand for an end user, you know, it can be even tougher. And that's where we really come in and we can help out and help paint that picture of what's going on in the marketplace. So the next slide, this one's a little bit crazy, but just wanted to kind of show you the different US power markets. These are on peak prices, and this is calendar 2025 pricing over the last 2 years. So out in the West, California, you can see they've been on somewhat of a downtrend. They've jumped a little bit with some hotter temperatures that are forecasted over the next couple weeks. But overall, the above normal snowpack, the reservoirs for water are full right now. California relies on a lot of hydropower, but they're in very good shape and has really pushed the prices down from, you know, these $90 highs back into the $65 range. The blue line represents Texas, Houston pricing, and you can see with that above normal temperatures, the reserve margin issues that ERCOT is facing. You know, Texas basically from February has been on just a steady upward trend, and we'll continue to watch how that goes. The heat is expected to continue to stick around, and we expect prices to kind of stay elevated there. The other mainly East Coast or Eastern markets have all been kind of trending along with natural gas prices. No big surprises, just kind of following natural gas. So I kind of talked about a lot of different things throughout a lot of different points, but at the end of the day, you know, basically what does it mean? You know, when we talk about indicators that are bullish, indicators are bearish. You know, when an indicator is bearish, we think that will help move prices down or keep prices in check. When an indicator is bullish, we think that the markets are going to move higher. And so based on what we just talked about, We feel the weather forecast for this summer is definitely bullish. The storage impact right now with the surplus is bearish. We'll continue to monitor that and see how long it does stay bearish as it starts to, if it starts to trend back towards that 5-year average, it'll kind of start to become a little more, we'll say less bearish and possibly even bullish as time goes on. Natural gas production with the recent cuts is definitely bullish. Drilling activity with the lower amount of active rigs searching for new sources of oil and natural gas, bullish. The increase, basically the 2 BCF a day return of the Freeport facility, in addition to the expectation that LNG exports are going to double over roughly the next 2.5 years by LNG plants that are already being constructed, as well as an increase in natural gas demand being bullish. That's going to go hand in hand with the summer weather. Our overall market sentiment right now is bullish. So with the way everything is currently set up, we think that, you know, as soon as this summer heat shows up, that it's going to start to, you know, push prices higher. Now, will they get the whole way up to that JP Morgan forecast? Time will tell, and it'll be based on the duration of the heat. You know, some hot days here and there is not as big of a deal as sustained heat. So with all of these factors, you know, probably the biggest one is going to be weather, is really going to dictate, because weather has such a strong impact on overall demand in the marketplace. So with all of that information, you know, it comes down to, for a customer to have a strategy. You know, if you don't have a strategy, let us know. We will talk to you. We'll go through your business, what you do, what your outlook is, how you budget, you know, right now for energy, and we can help you build that strategy and stick to that strategy. There are different ways to buy power. You can buy it all at one time. You can layer it in. There's index markets that you can ride on. There's a lot of information out there, but we can definitely simplify the process for you and help you come up with a good, strong strategy to help manage your energy costs. So with that, I just want to thank you, and please reach out to us if you have any questions.